Broadcasting live from the IRSMedic studios, it's Parental Advisory. And welcome to Parental Advisory. We are joined today by a special in-studio guest, attorney Sean J. O'Connor. What's the J for?
Joseph.
Okay, we like to ask everyone. Robert Hansen, was his V for victory?
I think that's what he did, yeah.
It was. Attorney Sean O'Connor is tax manager here at Parent and Wynn LLP. And what we want to discuss today is foreign retirement plans. A lot of people wanting to know if their foreign retirement plans are taxable. And from what I can ascertain, there's lots of if, ands, or buts and depends. I mean, there's no straightforward answer. So we pulled our in-house expert to see if we could sort of clarify some of the if, ands, or buts. Now, the first thing, Sean, when you wrote a great article about this that we're going to link on the video as well. The first thing you said is some countries cause more concern than others when we talk about foreign retirement plans. What's the difference in the different countries?
Well, this really boils down to the treaties we have with the different countries. I believe Attorney Hansen talked about treaties with you guys already.
Yep.
But the treaties will protect some of the income that would otherwise have to be realized on a 1040 until distribution.
Gotcha. So we're talking about countries like Germany, Canada, the Netherlands, that may not be taxable until distribution. Although you said those are likely, you need to still report those.
Right. There are still reporting requirements. I think the best example for benefits derived from a treaty in regards to foreign retirement plans is probably the UK. For example, the contributions to the foreign retirement plans are not included in your taxable income when you're contributing to a UK plan, whereas by default they would be.
So it acts like a regular 401k in the U.S. It's you're allowed to defer that income.
Right, exactly.
Right, and I mean that's one of the biggest surprises. And you got to love it because they say foreign retirement plans, right? Mm-hmm. It's not foreign in the country it is. It's like no, it's not foreign. It is where it's supposed to be.
Yeah. And you know what? When you talk about tax treaties, that in itself is an extremely complex issue. So to add that to the mix, I can't even imagine what you guys must go through to figure all this out. So for U.S. taxation purposes, you said all retirement plans, the first thing you want to do is divide them into qualified and non-qualified plans. You also said U.S. providers of retirement plans go out of their way to meet the qualifications, and why is that?
Well, there are great benefits to meeting the qualifications. Your typical 401k, you defer all the income, and then you're not taxable on that until you take distributions in your retirement. If you don't meet those qualifications, you're going to be taxable on the contributions to those plans now.
And that's basically what people are trying to sort of avoid.
Right. I mean, if you're not going to have what's the point of not having a qualified plan if you're looking to do it, because everything's going to be post-tax. And if you're going to be post-tax, well, then would be better off putting in something. And I'm a big fan of whole life as an investment vehicle because it's post-tax, and then everything's deferred, or everything it's earning is now tax-free. It's a great way.
Yep.
So that's really the pressure. I mean, everything's gonna be qualified, otherwise they're not going to sell it because you're not getting what you think you're getting. But my question is, so we have some, okay, and UK is a great example, and I think it is because that's one of the things where when I'm talking with a client, they'll say, oh, I have a retirement plan. I'm like, oh, no. And then they say, I'm in the UK. I'm like, all right. And that's the way a lot of things go. You go, oh, no. They say one thing, going back, and then it's back and forth. You're like, oh, this is terrible. Okay, let's save it. That's terrible. In the UK, this is something I don't know. If a UK is going to, if the treaty allows you to defer taxation with a plan like a 401k, but it doesn't, does that UK retirement plan have to be a qualified plan? I guess my question is, there's nobody at the IRS saying that this is a qualified UK plan, a blanket, and no one in the UK is going to say this is a qualified US plan. That's not really how it works.
Yeah, you're right. But because of the treaty, we don't hold them to the qualified standards in the same way that we would our own plans.
And so in a way, it's kind of easier wouldn't it be easier to get a UK retirement plan and have be in the UK, have a UK retirement plan that's sort of unique, as opposed to being in the US, having a U.S. retirement plan where you have to go through all of the, maybe this hypothetical, something that never would happen in real life.
I mean, you have to remember that having this UK retirement plan isn't exempting you from taxation. You're still going to be subject to taxation there. And who knows what hoops you have to jump through to have the plan qualified under UK law.
Right. All right. So, all right. See, I'm always looking for an angle here. I am. And yeah,
Sometimes
all right.
you get it.
Sometimes like, all right, that was a reach. It's not there. Okay, I got it.
I don't think the foreign retirement plan is ever going to be the angle you want.
It's not a safe place to go.
All right.
And a good point about the foreign retirement plans, the providers aren't concerned with U.S. taxation. When they create the plan, they're not going, oh, how does the most complicated U.S. or tax code in the world work? They're thinking about their own laws. So it's pretty unlikely that they're going to meet the 401 requirements of the United States.
Exactly. They really couldn't care less about the laws over here. And that really comes through when we start talking about the reporting requirements, because legally it's the trust in grantor trust that's supposed to be responsible, and non-grantor trust is supposed to be responsible for doing the 3520A. And these foreign trusts are never going to do these 3520As and file them with the IRS. And then that burden shifts to the grantor.
Oh, wow.
I think we should talk about these grantor trusts, and that's a scary word. I think that is scary when, as you're putting two things together. Trusts, people have an idea, then grantor. At least in my mind, I'm not the most complicated person. Grantor trust, well, what do you mean? What's that? You got me all scared. So can you just tell me a little bit about what a grantor trust is?
So grantor, I mean, if you just unpack the language literally, it's the person who's granting the money to the trust becomes the grantor of the trust. So if you transfer your assets to a foreign trust, you're going to be the grantor of that trust. The grantor trust rules are code sections 671 through 679. There's a pretty long list and reasonably sophisticated list of things that will convert something to being a grantor trust. And it's pretty all-encompassing now. 679 is written very generally in an attempt to prevent people from moving money into foreign trusts for any kind of tax advantage purpose.
So a grantor trust is me just saying, I want to put my money in this trust.
That's right. You transferring your money to the trust directly.
And the
Or
other,
indirectly.
and you have the employee's trust. And I guess, is that where the employer is going to put it into trust for you?
So an employee's trust is one of the exceptions to the grantor trust rules. And it comes with a whole different set of tax guidelines. To have an employee's trust, you need to have this set up through your employment, and you need to make 50% or less of the total contributions at any given time to that trust. Your employer needs to make 50% or more. And this is something that can really come around and bite people, because if, let's say you're employed and you have a foreign retirement plan through your employer's contributing, even if your employer is contributing 100%, and you work for a couple of years, you amass, we'll say, $5,000 in this retirement plan, and then you work for several years after, you move to a different job, maybe you just keep independently contributing to this retirement plan.
Oh.
You put in, well, as soon as you put in $5,001, now you need to split that into two separate trusts, which duplicates your reporting and just creates a huge burden.
Oh my
and also changes the tax consequences, because once it's a grantor trust, you're going to be taxed on the income year over year. Whereas with the employee's trust, you can defer that taxation until distribution.
Wow.
Okay, so all right, so the reason why they're going to tax the grantor trust, they're not going to allow you to use some smoke and mirrors with a grantor trust to say, hey, it's not taxable, but you gave it yourself, as opposed to when you're dealing with, when an employer is giving it to you, and as long as the employer is making more contributions. Now, and I think also one of the things too is a lot of U.S. persons who around the world, they move from country to country. They're moving from, somebody could easily move from a branch in the UK to a non-treaty country. And now you've had, and which is a little bit of a separate issue, because we're talking about their contributions into it. So you could have someone who's working in the UK, and let's just say they go to what's a good non-tax treaty country where they would have a similar, North Korea.
Very similar.
They move to a non-tax treaty country, and the employer is still offering the same exact thing, the same exact product, the same exact deferral. Now, they're making these contributions, what they think is tax deferred, but that's probably not true.
Oh, no, that would definitely not be true. As a rule, contributions to, not even to employees' trusts, non-grantor trusts, are included in your income when they're made. So those contributions are not tax deferred, which leads to an ultimate taxation when you take the distributions in the form of an annuity under Code Section 72.
Okay.
So you get basis in as much as you've been taxed on the contributions already, and then the inside gains you defer until distribution.
Okay, so at least, all right. So because I was just about to ask you, like, well, are you going to be double taxed, or you're going to get the worst of both ends? This is just you're getting kind of the worst, but not the worst of both ends, because you are paying taxes on your contributions. It's not going to grow tax free like a Roth would or a life insurance would, but at least what you put into it isn't going to be taxed again when you take it out. But I mean, now I'm thinking, oh my God, that seems like a horrible amount of compliance work, because now you have to investigate the contributions the employee has made this entire time. And I'm not imagining that this foreign retirement plan is going to give you the report. Oh, here's your report for the IRS.
You're exactly correct. They do not share information very well. And often people have no idea what they have. They don't understand what they have. Even they'll go to their employers to try and get an understanding of the plans and come away inadequately informed still. It's a mess.
And I would say, you know, when I'm upstairs visiting Sean's team, a lot of times what they're doing is they're creating, there's no reporting requirement that we're getting. There's no 1098. There's no 1099 with all the boxes filled out where you can just plug it into the return. These guys have to make it up.
Oh my God.
And they're, you know, and I look at, you know, you're looking at the scanned copies of, I'm like, whoa. And I'm like, wow, how are you guys getting this? Oh, God bless you.
Yeah.
It's incredibly onerous. And that's one of the traps, because isn't that right? I mean, that's why the amount of time it takes you guys to do this, it's like, yeah, the return wouldn't be maybe as bad. Well, actually, the foreign things are, but you guys are creating all of the input. I mean, that's really it.
Yeah, we have to come to an understanding of what's going on, and then we have to do all the accounting for that and just determine, you know, what goes where. The 3520A has a balance sheet and an income statement just for the trust. So there's a considerable amount that goes into just sorting out what the details are, especially when these forms that we do get, as inadequate as they are even still in foreign languages.
Wow. Oh. So all right, so Form 3520A. Okay. So what's the name of that form? Something? Foreign
trust reporting.
Foreign trust reporting. So you're saying that it has, because now there's a lot of foreign reporting forms. All right, they're just not foreign corporation, Claudine. Foreign corporation, you have your Form 5471. Form 5471 is absolutely terrible, because if it was a domestic company, you just put down your profit and loss. Okay, you're kind of done. Foreign, no. We need to know your balance sheet too. And we need to know it in this format that no one in the world ever uses. And we need you to take things that you don't have and create this entire thing. And so it's a nightmare. And now is the 3520A sort of the same thing?
Yeah, it's the form that's supposed to be filed by the trust that does all of the reporting for the trust. It should, essentially maintain the books of the trust as they pertain to the individual taxpayer.
And so I guess the employee's trustee could fill out that form, but...
So that's what's supposed to happen. The trust is supposed to be responsible for that form. But when you have the employee's trust, you don't have the burden of filing the 3520A. So when you have a grantor trust, it's essentially the trust is transparent. You own the investments within the trust as though you own them directly, which means if there are foreign mutual funds and other PFICs held by the trust, you take on the burden of the PFIC reporting. But with that also comes the burden of doing the 3520A if the trust fails to do the 3520A. When you have an employee's trust, that burden doesn't pass to the individual taxpayer.
And all I can picture, too, is Robert Hansen printing out the tax treaty and crossing out qualifying state, or contracting state, and writing United States, and then writing UK, and writing Germany. So you start with that, and then you go to 3520. Good Lord. And
that is... So there's a whole bunch of things you said there. I mean, that was... You know what? I'm like, oh yeah, that is what's there. That is what's there. Oh my God, this is so sort of nauseating when you think about the work that Sean and his team are doing.
Right. Thanks for coming down today.
That's right. It sounds like you need to get back up there. Wow. It's because he's talking about PFICs, and did we talk about PFICs before? Our passive foreign investment companies.
Not recently.
Yeah, it's a nasty little thing, and essentially, Do you want to handle a PFIC, or you want me to give my? I can give my my high school definition of a PFIC.
I mean, I can give you the abridged version. Generally, when we're talking about PFICs for most clients, we're talking about foreign mutual funds. It actually could encapsulate a number of other things. A lot of CFCs can also be PFICs, but
Controlled foreign corporations.
sorry.
It's lawyer talk.
Yeah, so we're essentially talking about foreign mutual funds, and the tax regime for foreign mutual funds is pretty rough. I mean, there are a number of different elections you can make to control that reporting, but if you don't make them timely and ahead of time, you get stuck with some pretty abusive reporting under the 1291 regime.
Well, and you were the one who coined this, because I think I was saying, if you want to understand the tax code, you have to think like the politician. And then you said in one of our meetings, like, you have to think, who is the strongest lobby?
Yes.
And I was like, and I think that's a more precise way of saying. So I think that will be the name of my book. I might give you credit. I might. Who's the strongest lobby? And the PFIC, it all comes down to who's the strong lobby, and it's Wall Street. Domestic financial services really detested the fact that U.S. persons could go find the same mutual fund. I mean, with the same name, but it's offshore, and they don't have this whole nasty SEC, this New Deal sort of antiquity to have to deal with. Or that was a little bit of editorialization, but they don't have all of those expenses. And so Wall Street, and this was, they went to Congress and when the tax code was reformed in 1986, and they said, hey, it's just not fair. These guys aren't getting punished as much as we are with the SEC, so you guys got to do something. And that's really where they came up with the PFICs. And it was something that's in there, and I don't think it was really, the PFICs were something that were kind of ignored, and it wasn't until the first OVDI program in 2009 that anyone really started thinking about it, because I think someone in the IRS, somebody really smart, to say, wait a second, these are foreign mutual funds. I remember a training back when that 1290, section 1291, 1292, section 1293, is that where we are?
1291 is the default rule for taxation at PFICs. Then you have your 1296 is the mark-to-market rules.
Okay.
It's a much more it's a much preferable
yeah,
way
mark-to-market
of
is much
taxing
better. We could have a whole, I think we're going to do one on PFICs.
Okay,
I
was just
think we
thinking
should
that,
do
actually.
that. Yeah, we really should.
Okay.
So, wow. So, I mean, how much more complicated things could you add
Well-
into? Okay, you're going to add something. 'Cause
I am.
All right.
Okay, so we're already confused.
Right.
And we've talked about grantor trusts and employee trusts. If it's an employee's trust, is it exempt or non-exempt? What the hell is the difference?
Well, yeah, I mean, I believe what you're talking about now is the highly compensated requirements.
Yes.
Right. Those are just requirements in the U.S. code to make sure that plans aren't overly favorable to highly compensated employees. They want to incentivize retirement plans that employers provide that benefit, their entire employment force, not just their executives.
Oh, okay. Gotcha.
So it is a small factor in these foreign retirement plans, but generally it doesn't come into play because most foreign plans are meeting these requirements.
Got it.
Especially when you have plans that are government mandated, like the superannuation funds.
Okay. So they watch out for the little guy.
Yeah, I mean, I think most of the countries, that's sort of that's how they all tend to work. All right. So I mean, I'm just trying to get a handle on sort of what we're dealing with here, because all right, you're a new employee, you're going to start this job. Let's say you're working in Microsoft in one of their branches in Germany, and that's a treaty country.
Yep.
And you're all excited, and they sit you down like, okay, let's go over your benefit package, and like, oh, here's our retirement plan. Like, okay, great. And you're just thinking everything's good, and you're not thinking that this is much of a big deal. And I think that as far as tax reporting goes, there are more complicated things in this, but not a lot.
Yeah, it's definitely up there. People are very confused when they start addressing this topic, and most of the information out there on it is just regurgitating direct quotes from the IRS, which doesn't really shed much light on it.
Not helping.
And
You know what? Let me go to irs.gov and I'll figure it all out.
And I think maybe this. Would you agree with this, Sean, that the amount of compliance work is up there with a multi-million-dollar offshore company, but what you're really talking about is a retirement plan that might be $10,000.
I think that's definitely fair because you have to go through and do all of the accounting and create balance sheets and income statements for the trust, and then create separate income statements as it pertains to the specific taxpayer.
So maybe if you are, maybe it's something because of the compliance costs when you're there at Microsoft in Germany, you say no thanks, and just tax me, and I'm gonna put my stuff in a post-tax life insurance plan or something like that, because this entire thing, and I think the thing is it's never really done right when we're reviewing returns.
Do you find that people try to do it on their own?
Oh no, but professionals aren't doing it right either.
Oh wow.
Yeah.
Pretty much across the board.
Yeah, you can basically look at any return that when you do see it done correctly, it blows you away, and you want to call that person and say, "Hey, this is awesome! You're
Sure.
awesome."
Yep.
The default is that my default expectation when I look at anyone's return, regardless of that signature down there, and it could be from a Big Four, regardless, that part is going to be incorrect. And would you? I mean, we're not trying to. It's just incredibly difficult in that no one is expecting this to be that friggin' crazy.
Well, you got to remember, like you said earlier, Anthony, it's like 2009 where this really became much more of an issue.
Yeah.
And most CPAs have been practicing for a lot longer than 2009, and they think they have a handle on everything already. They don't realize that there are more complicated issues that are springing up and things that they need to continue to learn often enough.
And then, one of the things is there's actually not enough CPAs. There's not. It's one of the things that most CPAs, all the good ones, are always too busy.
Yeah, that's true.
They're way too busy.
I call my CPA in November to get my tax appointment.
Right.
And I'm still on a wait list, even though I've been going to him for 10 years.
Right. And all these CPAs, CPAs used to be, great at, giving you business advice and sort of like, hey, this is what you should be doing. And now, and this is sort of the trend I've been seeing, is that they're dumped with so much compliance work. All they're doing is reacting to the additional compliance work that the IRS is foisting on them. Meanwhile, they're pressured like, well, I don't know if I have to increase my costs. I have to increase my fee to my client because there's so much work involved. But for the client, they're getting the, to them, they're getting the same, well, it's a tax return. But what's required is so much more, and everything gets harder and harder and harder. And that's why, these guys, the friends of mine who are CPAs, they're busy. They're definitely putting in, well, I know you put in the hours too, when it's getting close to crunch time. And I think that's also one of the reasons why we've said, the IRS says when we're dealing with a tax problem, they don't want to deal with CPAs because the CPAs aren't going to be around to handle their inquiries because they're burdened with more and more. I mean, Sean, could you imagine that if we said, hey, Sean, on top of your responsibilities, aside from doing these tax returns, we're also going to want you to handle some of the we want you to, call the IRS to handle some of the problems and process that. Is that even?
Yeah, no, I don't see how we'd arrange that.
Yeah, there's not enough time in the day. There's simply not. And there's more and more, and we're trying to get, and I know Sean's getting on top of we have a whole bunch of new due dates coming up. And the IRS is late. Most people don't know this. They'll come up with regulations after the year ends.
Oh, wow.
Oh, this is the tax treatment for 2015. And they'll announce that sometime in 2016. They can do that. Oh, I could have done that. Oh, great. Wonderful.
And you know what I think for the average taxpayer too, just finding out when I came and started working here that once you sign that form that the CPA filled out, you're responsible.
100%.
100%.
100%.
So, the average person is going to look at it and go, okay, even my, relatively simple tax return every year, I just sign. I don't even look at it. I just assume my CPA knows what he's doing. So I can see where it could turn into something a little scary, especially with the IRS and their wonderful penalties.
That's definitely an important issue across the board. People need to take careful looks at their tax returns. I deal with a lot of people as we're amending these returns who are upset and want to hold their last preparer liable.
Yes.
And they can't. They signed that. They signed to agree to the return. Unless there's some open fraud, it's pretty difficult to hold the tax preparer liable.
Yep.
And that's absolutely right. And we deal with a lot of, I think, you deal with a lot of high-end professionals too. And you deal with some very sophisticated people. And we're trying to tell them that you signed it. And I know it's, tax is not your specialty, but it doesn't matter. And here it is. Is this not unconscionable that you're requiring someone with a foreign retirement plan to sign this return.
That it took a team full of people 8 weeks to finish.
Right. It's absolutely crazy. And here's one of the things too. A lot of people who maybe they're reporting their FBARs correctly. Maybe they're reporting their offshore accounts. Maybe they know like, oh yeah, I know my interest bearing. I have to report. I know worldwide income. I've been reporting my income correctly. I've been doing everything correctly. And then when it comes down to what about your retirement plan? What about that? And that could be in non-compliance.
And speaking of, one of the things that Sean said in the article is why you may need to use one of the offshore voluntary disclosure programs when it comes to foreign retirement plans. So when would it fall under, or is that another depends?
Oh, it always depends. But I mean, this is like we've been talking about. This is a complicated issue. It's very easy for this to be a reason for you to be non-compliant, and often we could be talking about a lot of money, especially if you're in the stage where you're already taking distributions from these plans, because most people assume that they don't have to worry about U.S. taxation on their foreign retirement plan. Mm-hmm. They think foreign country's taxing it. I have it over there. I lived over there. I worked over there. There's no way the U.S. should even be worried about this. We have to really pull this information from people like pulling teeth. They just assume it's ingrained in them that this is a non-issue, and it's a big issue. I mean, we're talking about a $10,000 fine for failure to file each of these forms, 3520 and 3520A, or even higher. I think it goes up to 25 or 35%.
Yeah, I think if they ask for it and you don't provide it, then it can kind of go up, sort of incredible, right? And you're exceeding. A lot of times these penalties when you have both of them and the statute. And now is the statute, if you don't file it, the statute on assessments is
open forever.
Open forever.
Oh wow.
Yeah. And it's just you have to think of it. It's like, I wouldn't say peeling back a rotten onion. I don't think that's the right analogy. I think it's you're going into a building that you think is this big, and every room is getting exponentially worse. Everything is getting far worse because you're learning, oh, it's taxable. Oh, not only is it taxable, the compliance work is crazy. The penalties are crazy. You are not in the position you thought you were in. I mean, that's one of the greatest ways to upset anyone is change their expectations. Your expectations, like, oh, I have this amount of money. Like, yeah, let's just cut that in half.
Right.
That is just the horrible surprise. And a lot of people, that's why they're like, I don't know what I'm going to do. I'm just going to sort of pretend it doesn't exist. And that's, one of the options people are doing.
So the forms you're talking about, Sean, these have to be filled out every year with your tax return?
It depends on your situation. So if you have an employee's trust, you don't have to file them every year. You're only going to file the 3520 upon distribution.
Yep.
But if you have a grantor trust, you need to do the 3520 and the well, technically the trust needs to do the 3520A, but that's just never going to happen. So you need to do the 3520A every year. And it's also important to note that the 3520A has, at least still currently, a different deadline than your 1040. It's the third month of the tax year of the trust.
Oh, wow.
Well, the 15th day of the third month of the tax year of the trust.
Oh,
so March 15th generally.
So different dates, just for you. All right. So if we're talking about foreign retirement plans, are they taxable? Just to recap, we first want to see what country it's in. If it's located in a tax treaty country, it's going to be treated differently. We want to figure out if it's qualified or non-qualified. We want to remember that foreign retirement plans are considered foreign trusts, actually. And then when you have to figure that out, is it a grantor trust or employee trust? So let's just say someone has either tried to do this himself or went to a professional, and they figure out basically that they're non-compliant. What then? I mean, are they screwed? Is that it? Or can they try to come clean, or do they continue to try to hide? What's the best?
Well, that's why we have these disclosure programs. I'd say it's worth it just for the peace of mind when you have these kinds of penalties hanging over your head. Most people come out of the disclosure program and pay less in penalties than they would have just for the penalties on the forms.
Okay,
right, yeah.
So they're still negotiable.
Yeah, and negotiable in aspects. And if you're also overseas, if you are still overseas, oh my God, disclose. The program is just there's no penalty. Mm-hmm. You just have to
wow.
Yeah. There's no offshore penalty. If you're an expat, you do it now. I don't know how long it's going to.
I was going to say,
yeah,
how long will the IRS let that go?
Yeah, so I don't. You really want to get going on that because it's, really your big expense is going to be, because a lot of the taxes on it's not going to be a lot. Your big expense would be with us, just getting all the stuff done.
Yep.
And then once you see what we're doing, you can say, oh, okay, I see why they charge what they charge. I got it, because we're creating all the statements. So really, for the expats, it's really awesome now. You don't have to go back. You only have to go do 3 years. The standard program, it's 8 years, and so 8 years times whatever, you can see how this can get up to the price of a luxury automobile,
and then they'll take your passport.
Right, and there we have that too. There's the new law, the passport law, and that's really a risk that the IRS could come along, assess these penalties, assess your back tax. You didn't fight it. They're sending the notice to the wrong place, and now I guess that's they're supposed to send you that certified notice, but if they're sending it to the wrong address,
or overseas,
you moved from UK to, say, Egypt, and then you're trying to get home, and hey, we got a little bit of problem here.
Just take your passport.
Geez.
Yeah.
Well, you can get back. You can get to the United States. You just can't get back to your home in the foreign country when you try to leave. That was my understanding. They'll allow you to ingress back to the country, but not leave.
Well, that's nice of them.
Yeah.
They'll hold us
Back and pay
captive.
us.
Is that not a worst case
Yeah.
scenario?
Yeah.
You're stuck in the U.S. and your family and your business and everything you have is in a foreign country?
Mm-hmm.
Well, we were thinking of a hypothetical that if you were traveling, let's say you were traveling from Egypt to Japan, would Japan necessarily let you in? You would have to find a flight back. You're like, okay, no one's going to let you in, but you have to go back to the U.S.
But how
So
could
you're not
oh.
stuck, but you're going to be very uncomfortable and probably spend more money than you
You're gonna be
anticipated on that.
somewhere you didn't want to be.
You'll be waiting around on an airport somewhere. Like, yep, just waiting for that flight back to the U.S. That'll
Yep.
be fun when I land. Yeah. What am I going to do? Oh, yeah.
So definitely it is worth disclosing.
Yeah. What is this? I'm trying to think of this analogy. Usually I'm good with the analogy. Just you're thinking it's just this amount of terrible, and you're not even close. You have it's exponentially terrible as you sort of go through everything. And
Yes.
man, I am just
Well,
not
it's
able
one of
to
those
think of
too,
it.
where I think people are so like they think they might have a problem, but it's so overwhelming and scary they just stick their head in the sand.
Yeah.
And it's better just to make the appointment. Find somebody you trust, go to a professional, and have them look at it
That's right.
instead of trying to do it yourself or go to IRS.
Yeah, I think we also
GOP.
need to get an analogy generator.
Okay.
So I could just press the button
Like a mini generator?
I'm usually yeah. I
We'll come up with it, and we'll post a meme with the
yes,
analogy.
I know.
next
Yeah,
to the
so look
video.
on look on IRSMedic for it will come through. I know it will.
Well, Sean, thank you so much for joining us today. We did learn a lot, but we also did learn it's extremely complicated, and every situation can be made better, but you definitely want to find the right help to make that situation better. So thanks for listening to Parental Advisory. Thanks for joining Parental Advisory, hosted by Anthony Parent, produced by Claudine Gindel, that's me, engineered by Chris Chen. For more podcasts, visit our website at parentaladvisoryshow.com and like us on Facebook to submit story ideas. We'd like to thank our sponsors, IRSMedic.com, the law offices of Parent, and Wynn, LLP, real tax attorneys for tough tax problems.